So this securitization is progressing everywhere except possibly in Singapore. I just went through the frustrating process of trying to get a mortgage here in this place. And since I'm over 55, the banks don't want to lend me anymore. And so I offered them to buy the mortgage from them through my investment company, securitize it, in other words, personally. The answer was typical Singaporean, and that was cannot. So there's still a way to go. Anyway, this whole securitization and financial engineering has ultimately led to a great change in the financial industry. And you know yourself here, the number of banks has shrunk. In one hand, on the other hand, the government has found in its wisdom to allow more international banks to come here and finally get involved in the retail market rather than only the wholesale market. And slowly but surely things are improving. For most of us a little bit too slow, but there is progress. So the change in the institutions. In other countries, of course, the changes have been much more drastic. I have a good friend, school friend of mine, who's been in the financial industry in Seattle for many years. He tells stories that he's fond of telling a story that he has changed within 1 decade banks 3 times without changing offices once. Reflecting, of course, the tremendous wave of mergers and acquisitions that have taken place in that industry. Just to put it up as an example, in the US 10 years ago, let's make it roughly, we had over 13,000 banks. We're now down to 7,000, although every year the federal government issues about 500 new banking licenses. So it's not only that the whole population shrinks, there are new people coming up all the time. Myself, a typical middle-class investor and consumer, I have found, for example, that no bank can service me as well as some new entrants who are not even banks, people like Fidelity or Schwab or Vanguard in the US, which are originally sponsors of mutual funds, but they have branched out and they now offer money market funds, which again is unheard of. So when the university used to pay my salary in my fund, it started to earn on the very first day 30 basis points below LIBOR, that's the wholesale rate if it interests you, rather than being in a current account or what we call a demand deposit account, earning fees only for the bank. These things have progressed very well, and in other countries they are coming too. I have, because of my international consulting practice, I have accounts in Europe, I have accounts obviously in the US and here, and so you can see what's possible, what is not possible, and you see amazing differences in terms of services that are open to retail investors. Anyway, just to make a last, give you a last little anecdote here. About a year ago, I decided to, for the first time, buy a bond in Brazilian currency, the real, because a former student of mine has become the president of the central bank, and I thought the inflationary times in Brazil are now for a time over, and so I would venture a little bit of my pension fund on that particular bond, especially since it yielded 12%. So I tried one of the local banks, and again the answer is Brazilian currency cannot. So I went online and tried it with my online account with the German postal system, and the answer was not only can, but can. They really did it. So there are, that is today open if you are a little bit international, and that is what I'm trying to talk today. Now, let me talk about my philosophy and what I picked up from the literature. And obviously, one of the old and most original issues that comes from Mark Twain, who has been quoted as saying, if you want to be rich, put all of your eggs in one basket, but watch the basket very carefully. Of course, this goes against the alternative principle of investing. Don't put all your eggs in one basket. Now, since I want to sleep occasionally, and I have learned that surprises are surprises, they come unexpected, you cannot forecast them. I have been convinced in my lifetime that the second principle is better. However, if you know something about in detail, and you're sure that you are among the first to know something, the first principle will work too and will make you rich. But you have to be very sure that you are at the stage where you get the information among the privileged few, and in Singapore as well as other places, you don't run into insider trading laws, which, as you know, may get you fines in Fine City, or even worse, if things tighten up, out to the other end of the island, the eastern part. So, first principles first. Sounds a bit academic, but it's quite obvious. There's an excellent book, by the way, those of you who want to read it. It's in the, since we're in the library here, and I'm sure they have a copy, by John Campbell and Luis Becerra on strategic asset allocation, where you get it with lots of formulas, etc., etc. I have only picked out some of the principles that this excellent book presents. And basically, if you look down, all good ideas are basically common sense ideas. Asset allocation depends on three things. First, what assets are available and accessible? Secondly, what are the expected returns and risks? The estimate of future based on past data. By the way, anybody who would like a copy of the slides, all you have to do is, send me an email to gtufei@umish.edu and you can get it, so no problem. So the first principle here are, what are the assets available? What are the expected returns and the risk? An estimate based on past data. And most importantly, what are the circumstances of investor age, work, location, future expenditures? And I will illustrate that a little bit more. So, how do we structure the decision process? What's an orderly way that academic study of investments tells us? The first question is always, do we have active or passive investment? I still remember a few years ago, it was shortly after, it was after Tiananmen Square, I was sitting with some alumni in Hong Kong, and one of my former students called me afterwards and said, you know, my parents want to invest some money outside of Hong Kong. We want to buy a company in the US. I said, well, what company do you want to buy? And he said, oh, any company. I said, well, that's a first-rate way to lose money. So I think the answer is, the question here is, do you know something that the locals do not know about this line of business? If your answer is no, don't buy a company abroad. There are, as always, exceptions. For example, if you happen to live in a country which capital controls, like China or other places in the thing, sometimes to get your money out, you need an excuse. And the excuse can be that I want to do business abroad, promote my exports, need a warehouse in Los Angeles or wherever, and that will probably get you the permission to take your money out. If you just come to the authorities and say, I want to have $500,000 of my savings outside of the country because I don't trust things here, they will probably not. They will probably say cannot, to put it in English. Or there are immigration issues that are, of course, of interest to people in this region. Canada, Australia, US, and many other countries have provisions that if you invest in a business, any business, enough money, then you will get a green card or whatever working permit you get. So that, again, is an example. But normally, if you just want to have your assets diversified, don't buy a company. This also applies to real estate.